Hey harvesters, and welcome to Project Premium Harvest. My name is Matt. In today's video, I'm going to be going over the options trade I have done over the last 2 days. Didn't make a video yesterday, was super sick and under the weather, so I didn't want to sound all nasally and all sick and coughing and sneezing and mucus. So I just wanted to bypass that whole interaction. Just going to wrap it up today and then get the ball rolling. Definitely made some mistakes trading in the market, and I'm going to discuss what I did, what I could have done better. I think the intent was in the right place, just the execution and choosing a specific strike price was a little bit off, and it happened to be bad timing of the market. You guys know me. The first thing I'm going to show on my channel is my account value. So I want to show you I am a trader. I'm not just making up numbers. Here it is, $86,293.39. Let's go to spreadsheet. Let's talk about all the different trades I've made over the last 48-hour period, and we're going to discuss wins, losses, what I could do better. And then after that, we'll go to Robinhood, and I'm going to discuss what I plan on doing in the next 24 hours. So let's talk about April 22nd, yesterday. There was a lot of red, and that's never a good thing. But before I talk about the red events, let's discuss the circumstances that led towards me running these specific options. So when I bought my 200 shares of SPY, the first set of 100 shares, I bought at the 527.82 price for S&P 500. And then the second set, I bought at $540.29. So this is important whenever choosing strike prices. So basically 100 shares is one contract. I sold 2 contracts because I had 200 shares of SPY. So that netted me $256. That was a huge amount of money for a single day of running daily covered calls. And the reason why I made this much money is because when the SPY opened on April 22nd, it was trading at $19.70. And the trajectory of where the market was going, it was chopping normal or chopping down, chopping normal or chopping down. So I wanted to be very aggressive. Usually I do something that's like $5 to $10 away from that current strike price. So I usually choose something that's $5 to $10 away from this 519. So that'd be like 524 or it's somewhere between 524 and 529. So that's a relatively safe chop zone. But I was a little greedy. I wanted a little bit more premium. So I decided to choose a strike price that was closer to at the money at that 519. So I chose 2 contracts at that 523, which was pretty good. So I made a lot of money. But the problem was there was news and hype in the market. So let me discuss that. So on Tuesday, the market shot up because there was decent earnings reports by some of the bigger companies out there. And there was significant signs of like tariff news coming out. So we were making talks with India and talking about a good way forward. We're talking about easing, trade war with China. And then Scott Bessett said some positive news. Therefore, it shot the market. So the entire day, the market was hovering around, 519, 523 in there. And then by the time 30 minutes to an hour before the market closed, that's when you can roll options, at least for Robinhood. I don't know how it is for Fidelity, but there's an opportunity to roll options. So at about 12:30 Pacific Standard Time, so usually that's 30 minutes before market closes on West Coast time is like 1 p.m. So about 30 to 40 minutes before the last opportunity to run options on the West Coast, SPY was trading at $524.68. So I saw this, I was like, I do not want my shares to be assigned at that 523. So I decided to roll my options. So this is what this first red is. So basically this red and this green. What rolling an option means is you are buying your current option out at whatever the premium is. You had to pay about $213 per contract. So that's where the 426 comes from. So I had to pay out of pocket to pay back I had to pay out of my pocket to buy back the options I was selling. So I didn't sell them at a loss. And then I rolled them. So I rolled them to choose a different strike price. So then I chose the 526 strike price. Yeah. And then I moved the covered call out to about the 526. This is my thought process. The SPY was trading about 524.68 when I rolled the option. And then I thought, I didn't think the market was going to move higher than where it currently was. So I took a gamble and went to 526. In hindsight, I should have picked a strike price way further out. I should have done like a 530. Hindsight's 2020. When my shares were assigned, the S&P 500 was at 527.28. So theoretically, if I chose a 528 strike price, if I just would have won $2 more, I would have had paid more premium out of pocket to buy my calls back, but then I wouldn't get them assigned. So theoretically, I would have saved about $1,000 loss if it would have executed the right way. So this is what I was saying in the beginning. In theory, I was doing the right thing. I was rolling my options so that I can buy out the ones that were going to get assigned, and then I was going to move it further away. But the price I chose wasn't far away enough. Another method I could have done to prevent this whole thing, instead of rolling the option, if I'm uncertain of where the market's going to go, it's still trending super bullish, I could have just bought out of the covered calls. I would have lost $426. I would have took whatever the difference between 256 and 426 is. That's the difference of $170. I could have just took a $170 loss, lived to fight another day, but I wanted to be a little bit more greedy and I wanted to still cash in some more money. So that's why I rolled it. I paid the price dearly for that because when I rolled it, I basically took a $182 loss from the price I bought my first 100 shares of SPY. And then I took about a $1,400 for the second set of 100 shares of SPY that I own. So if I just wasn't greedy, I could have just bought out of the options, didn't have to roll it out and choose a different strike price and then risk losing my shares again, and then would have took a $170 loss. To me, in hindsight, that makes more sense than rolling it. So the next time this happens, I'm not going to roll my shares. The only time I'm ever going to roll my shares, if the market is way below my strike price, I'll probably just sell out at the current price. Premium is going to be pretty low to buy out the current contract, and then choose at the money mark that's a little bit higher so I can maybe squeeze a little more premium. But I also think it's a little too risky, and that puts unnecessary risk on the shares that you own. Next time, instead of incurring this kind of loss, I'm just going to buy out the option, call it good. Take a wrap, take a knee, reevaluate, reload, rearm, and then let's fight another day. So because of a mistake like that, I went down almost $1,700 in the hole. But that's not completely bad. We're going to scroll over to how my last 8 trades have gone, and then it's not so bleak and bland. So then before we go to the holistic picture, let's go over what I did today. So today I thought the market was way too high from what it was trading at yesterday. The market for the S&P 500 opened at $540.45, and there was no way that I think that was going to maintain itself. So what did I do today? I did a cash secured put on one contract of the SPY, and I netted $84. Basically, all that happened for the cash secured put. Some investor paid me upfront money so that I can lock in buying shares. I chose a $535 strike price because the open was about $540, and I have bought the SPY at this price about a week or two ago. And I thought this was a little too overpriced because the market went down pretty much immediately after that. And that's exactly what happened today. The market went down, and then when the market closed, it actually closed at, I think, $535.45. So I was basically about 45 cents from getting these 100 shares of SPY assigned to me. However, I would be fine getting these shares assigned to me because I think 535 is a relatively good price. But this is what I plan on doing for tomorrow. So tomorrow, because the SPY is trading around 535 right now, I think I'll probably do another $5 put or cash secured put so I can rack in more money and potentially buy the spot S&P 500 at a lower cost, because I definitely think over the next 2-week period, market's going to continue going down. There's a lot of positive news today, but there's no financials to back anything unless another trade deal comes out. There will definitely be optimism. The market might shoot up, but I think if there's not enough optimistic news, the market's going to just chop at neutral or trend down. And that was the case today. It was neutral or went down. So for April 24th, I'm probably going to do another cash secured put. I wanted to highlight this daily tracker portion, guys. So I started doing these daily options trading and these weekly cover calls on some of my other funds like Oracle shares, and then cash secured puts on nvdy. Over the last 8 trading days, I've netted $1,295, even with this monumental screw up yesterday. So basically I won, of these 8 trades, I've won 7 out of 8 trades. So I have a winning percentage of 87.5%. This trade here, this could have been mitigated if I just would have bit the bullet and bought out the covered call that someone paid me for, just paid them back, maybe a little bit higher than what how much money I made. I would have rather have taken a couple $100 loss than a couple $1,000 loss. That is my hindsight, but end of the day, I've only been doing this I've only traded 8 days. 8 days, and I'm up $1,295.03. If we don't have this monumental screw up, we're in the $2,000 to $3,000 in 8 days of trading. So the trade win ratio is at 87.5%. One mess up ruined it a little bit. I would say a little bit. It definitely took up 50% of my earnings over the last 8 days. But I'm going to learn from that. I'm never going to let that happen again. If it does, roast me in the comment section. But I'm still, end of the day, positive $1,295.03. Just because you have a big loss doesn't mean you're a total failure. We learn the most from our mistakes. So we're going to take this on the chin. We're going to plan better next time. We're going to have a better course of action, and we're going to move forward. Okay, guys, we are at the SPY overview. Right now it's trading at 534.63. See, look, called it. It's going down. And I got lucky that the market closed at 535.45. All right, but let's go to my favorite button of all time, this Trade SPY options. We look at this. What do we call it, guys? Money printer button. Let's go. Let's click on the money printer button. Boom. So what we plan on doing for tomorrow, I'm looking to do maybe another sell put. So whenever I do covered calls, for a covered call, you have to own the 100 shares of the underlying to run a contract. So you have 100 shares, one contract, 1,000 shares, 10 contracts. Simple. But for put, you don't actually own the shares. You just have to have collateral set aside for Robinhood to just use as collateral to hold until the option is either executed or expires. If the cash secured put, like you gauge your premium upfront, so investor pays you to offload their shares at a specific price. And then if that price doesn't get at the money or below, you keep the premium, don't get any shares assigned. But if, for example, we chose a 535, like say, for example, what I did today is say I chose a 535 cash secured put. If it actually end of trading day was 534, I would have these shares assigned. So I would have to buy them at the 535. But that didn't happen. I got to bag $84, get to fight again, and then rinse and repeat. So since the S&P 500 share price is trading at that $534.52, I'm thinking of choosing something that's $5 away from that. So I might choose a premium of like 530, maybe 529. It really depends on what the premium looks like in the morning. If I can choose something down here, like for $100, like say, for example, I see this 526 and it's at like $113 for that contract, I'm going to choose that because there's a huge $8 buffer from the current trading price to what it is right now. I'd even want to choose something maybe even $10 away at this 524 or better, like $85. That's what I made today. I'll choose 524 strike price. So that means the only way I would get this cash secured put assigned is at the trading day. It's at $24. If it's 524.01, not assigned. If it's at 524 even, assigned. Or if it's 523 or lower, I'm going to have them assigned. So choose this guy. Somebody asked about deltas. I don't really care about deltas. Be honest, don't really care about deltas. Sure, they give you a little bit more information, but I think if you have the right fundamentals, you don't necessarily need this number. And people like to go into fundamentals a little too sophisticatedly to the point they're missing. Like the market going up today had nothing to do yesterday. The market going up yesterday had nothing to do with fundamentals. You could have had the stars aligned. You saw the right pattern, this freaking bull momentum or short momentum. Good news, like what happened yesterday, all that stuff goes out the window. So at the end of the day, it doesn't matter. Sure, it's a technical indicator that can help you predict something, but end of the day, it's always the best guess. So all of these things here, they don't really matter. But yeah, I would choose this 524 cash secured put. See what the market does at open, and we'll go from there. But yeah, guys, that's pretty much the video. Hope you learned something new today. I certainly did. In hindsight, what I did had the right intention. The execution was off. If I were to redo it again, I wouldn't have rolled it. If the market's going up and going against what I'm doing, I should have just bought out of the call. Would have never had to deal with the whole shares getting assigned, and I would have lived to fight another day with those 200 shares of SPY. But now I don't have any shares of SPY. I'm kind of just weaseling around to find the right strike price to buy for the day, or the right buy-in point for those new shares. So it's kind of like a weird gray area. Hindsight, I would have just bought out the options, took in the L, wouldn't have lost as much money, and would have continued forward. But guys, we live and we learn through our mistakes. Matt out, and I will see you in the next video.